Hi everyone, welcome back to Corporate Decoder, the place where we dive deep into the documents that shape the business world. Today we're cracking open Seadrill Ltd's proxy statement for their 2025 annual general meeting. Sounds boring, right? Well, hold on, because hidden in these pages are clues about where this offshore drilling company is headed and whether they're drilling for success or just sinking further into debt. Let's get started. The company's letter to its shareholders sounds pretty upbeat, like most shareholder letters. They are focusing on streamlining operations, optimizing their assets, and adapting to the market. It highlights their focus on the drill bit initiative, apparently trying to cut the fluff and concentrate on what makes them money. They're calling themselves a premium floater pure play, whatever that means. Apparently, to be a premium floater pure play, they are selling off their non-core assets like those jack-up rigs in Qatar and integrating some fancy drill ships they got from Aquadrill. This move away from jack-up rigs means Seadrill is betting big on deepwater drilling, which can be riskier but also more rewarding. They made around $400 million in asset sales during 2020-24. Seadrill seems pretty happy about its financial situation. They bought back a lot of shares and reduced their issued share count, which is just a fancy way of saying there are fewer shares out there. Less shares means the value of each individual one goes up if the company does well, plus they're sitting 5 millionaires to be exact and have a low debt compared to earnings ratio. But they also warn of headwinds or challenges in the offshore drilling industry, which means they are not expecting smooth sailing. They secured $1 billion in contracts in Brazil at good rates, which provides some stability. They're also trying to cluster their rigs together to save money and improve efficiency. Seadrill opened a real-time operations center called the West Minerva. This is their attempt to use fancy technology to keep a close eye on operations and make them safer and more efficient. All this means they believe tech can give them an advantage. They are bragging about drilling 100 managed pressure drilling wells and installed a new NPD system on one of their ships. Seadrill moved its corporate office from London to Houston, Texas, to be closer to customers and suppliers, which they think enhances efficiency and strengthens relationships. Now let's talk about what's actually on the agenda for the annual general meeting. There are a few key items shareholders will be voting on. First, they'll decide how many people should be on the board of directors. Second, they will vote for the re-election of current board members. And third, they will vote to approve PricewaterhouseCoopers as their new accounting firm. The first proposal is about setting the number of directors at 9. This is pretty standard stuff. It lets the shareholders decide the size of the leadership team. Next up is re-electing the current directors. Shareholders get to vote on whether they want these folks to stick around and keep steering the ship. The company wants PricewaterhouseCoopers, or PEOC, to be their independent accounting firm. Shareholders get to approve this, ensuring that the books are being checked by a trusted and unbiased third party. However, there is a twist. Apparently, they switched accountants because they are now considered a US domestic issuer after closing their England office. Seadrill fired their old accounting firm PEOC UK and hired PEOC US. There was no disagreement of foul play there. This is because Seadrill changed from a foreign company to a US company for SEC purposes. Now, a peek at the fees paid to P2PEOC UK paints a picture of the scope of their work. In 2024, Seadrill paid them roughly $3.7 million for audit fees and another $545,000 for audit-related services. That's a lot of money. The audit committee basically vouches for the financial statements, saying they believe everything's above board and in line with accounting standards. Here's where it gets a little interesting. The shareholders will get to approve the amount that Seadrill's directors get paid. Shareholders are being asked to approve how much the directors get paid. Basically, the non-executive chairman receives $180,000 and an equity award worth $150,000, and the other directors get $140,000 plus equity worth $120,000. Each committee chair would get extra pay. Some of the directors got an incentive fee for sticking around after the company went through bankruptcy. It was about $449,000 each. Now let's get to the executive pay. Shareholders get to vote on whether they think the top executives are being paid fairly. According to this filing, the executives' compensation is designed to be competitive, performance-focused, and aligned with shareholder interests. Translation, they think their executives are worth the big bucks. Seadrill's executive compensation program has a few key parts: base salary, annual cash bonuses, and long-term equity awards. These are pretty standard ways to pay top executives, and it's all designed to get them to perform well and stick around. Seadrill has a committee dedicated to setting pay and making sure it lines up with how well the company is doing. They work with an outside consultant to make sure everything is fair and competitive. Seadrill looks at what other similar companies are paying their executives to stay competitive. These peer companies include Diamond Offshore Drilling, Noble Corporation, and Transocean. Most of the compensation is performance-based, with smaller amounts paid as salary and benefits. These executives can make huge gains, but they only vest in 3 years. This gives them incentive to keep the stock price up and company doing well over the long term. This scroll section shows the amount of shares these executives own. The amounts can be huge, with the CEO owning millions worth of shares. As the share prices increases, they make a lot of money. But as the stock drops, they lose just as much as other shareholders. For 2024, the CEO pay ratio was 148:1. This means the CEO makes 148 times what the median employee makes. Now let's get into the pay versus performance section, which is required by the SEC. It's all about how the company's performance lines up with what the executives are getting paid. If the executives make a ton of money, but the company does not do well, there may be a misalignment. This pay versus performance section essentially states the CEO made $8.3 million, while the average of all the other executives was about $2.7 million. The company did make $440. Executives were paid more and the net income was lower, which may point to a compensation issue. Finally, Proposal 6 is about how often shareholders get to vote on executive pay. They can choose every 1, 2, or 3 years. The company recommends every year so shareholders can keep a close watch on things. Now let's take a look at who owns this company and controls the votes. There is a large amount of institutional ownership, such as Canyon Capital Advisors LLC, owning about 8% of the company. According to this part, only about 2.8 million shares are available. With big institutions controlling this amount of voting power, there is very little room for retail investors to affect any of the outcomes. So what's the story here? Seadrill is trying to get smaller and leaner by selling off parts of its business and focusing on high-end services. They're highlighting financial discipline and operational efficiency, but they're also facing some pretty serious headwinds in their industry. It is likely that their stock price is tied to the price of crude oil, which is very volatile, so be ready to hold this stock for a long time or be ready to jump ship as the price moves. While the executives made a lot of money, the company had a huge net income, but in previous years that wasn't the case. Looking ahead, Seadrill is taking a gamble on deepwater drilling, and its success will depend on keeping costs down and securing those big contracts. Thanks for watching. If you found this breakdown helpful, be sure to like, comment, and subscribe for more corporate deep dives.